Thank you. It looks like most people have now joined. So good evening and welcome to the Yew Grove REIT investor presentation. With me this evening are Jonathan Laredo, the CEO, Charles Peach, the CFO, and Michael Gibbons, the CIO. My name is Tim Metcalf. I'm from IFC Advisory, the company's financial PR and investor relations advisor. We're delighted with the response this evening to the webinar, and we should be having over 60 attendees with us this evening. Some of you will know Yew Grove well, others will be new to the company, but I hope through the presentation you find areas of interest. We will, at the end of the presentation, have the opportunity for a question and answer session. Given the number of people who are attending, it's not possible to go to individuals to ask them to unmute and verbally put questions, but there is a Q&A button at the bottom of your screen. Please do utilize that. I will be looking at that throughout the presentation, and at the end, I will be putting questions to the team. So please, anything you would like answered, if you can input your question there, we will endeavour to get through them at the end. And then without further ado, I will hand over to Jonathan to take you through the presentation. Jonathan.
Thank you, Tim. Good evening, everybody. Over the next 35 minutes or so, we're going to introduce you to Yew Grove. To those of you who know as well, apologies for repetition, but I think it's useful to give those of you who don't know us a real introduction. I hope you get a good sense of who we are and what we do, but as Tim said, if we miss anything vital or there are questions you've got, please ask the questions through the Q&A button and we'll endeavour to answer everything at the end. I'm going to give you an overview of the company strategy. Charles will spend some time taking you through the key financial metrics that drive the company and make it what it is. And Michael is going to outline the portfolio and then give you some examples of how we use asset management to drive increases in our rent roll. So, Yew Grove is a REIT, Real Estate Investment Trust. We're one of only 3 Irish REITs, and we're by far the smallest of those REITs. We invest in offices and industrial buildings, and we look for buildings which are situated outside the centre of Dublin, outside what is known as the CBD, the Central Business District of Dublin. We like those buildings that are attractive to multinationals or government bodies, and that's because we like the credit of the multinationals or government bodies, and after all, credit is important because they pay the rent on your buildings. We like locations where there are an excess of people looking for space, excess of suitable tenants looking for space, and a shortage of suitable buildings, because that gives us the driving metric that keeps our buildings growing in value. And we like our market. It's the regional office and industrial market and the suburban Dublin market. We like that market because it allows us to buy institutional quality buildings with high quality tenants at yields of between 6 to 9% on an unleveraged basis. And in the 13 months from our flotation, we floated in June 2018, or so it's about 29 months, we have grown our portfolio from 25 million to 141 million. And when you look at the slide on the top right-hand corner, you can see that the quality of our tenants has actually been improved through that time. We've reduced our exposure to small and medium enterprises. And we look in the bottom left-hand corner, and even though the portfolio has grown multiple times, the reversionary yield, which is the definition of the entire portfolio let at what our external value is considered to be a market rent, the reversionary yield has stayed at approximately 9%. So what is the background and the strategy? Well, the first thing to understand is the macro background, the key economic background. So Ireland is one of Europe's success stories. It is a young, vibrant, open economy. Successive governments have really championed an industrial policy that encouraged fast growth industries to situate themselves in Ireland, and they've done that incredibly successfully. So in the last 20 years, there's been a focus on life sciences. There's been a focus on attracting tech companies. There's been a focus on attracting specialized engineering companies. And those companies come to Ireland for a variety of reasons. A number of US companies are here because Ireland is part of the EU. Most companies used to come to Ireland because it was an onshore tax haven. Today, Ireland has a tax rate, corporate tax rate of 12.5%, and that tax actually underpins most of the budget surpluses in the country. But the most important reason that people come to Ireland is for the young, well-educated population. Ireland has one of the youngest populations in Europe. Almost half the population is under 35, and they are a very well-educated population. So more than 50% of the FDI, foreign direct investment, multinationals, has been invested outside of Dublin over the last 2 years. And it's been a huge success story. Multinationals employ 230,000 people directly and almost 200,000 people indirectly through local suppliers. That economy has grown and sustained Ireland through what has been a very difficult 2020. When we look at the microeconomics, the economics of our market, the property market in suburban office and industrial market, we also see strengths. Following the global financial crisis in 2008, 2009, almost nothing got built in the office and industrial market for almost 6 years. In 2015-16, you started to see construction in Dublin. And since then, most of the new construction of commercial real estate has been situated in Dublin. Although we've started to see some development in Cork, and we're starting to see green shoots in Galway and Limerick. But notwithstanding that lack of construction, the businesses that were situated there have grown and grown rapidly. From 2015 onwards, we've seen a huge growth in the underlying businesses, whether they were already situated there or they're newly situated in regional Ireland. And as a result, more businesses were looking for space, and slowly but surely they've soaked up the available space. And those businesses that needed new buildings or needed upgrades to buildings have had to historically finance them themselves because of the lack of development. What that means is that we have a situation with historic multi-year low net vacancy in our market. Rents are still below the level at which we would expect to see speculative development. In the industrial market, we are close to an equilibrium level. In the office market, rents are between 10 and 30% below the equilibrium level. And because of the continuing demand, that is driving rent increases and will continue to drive rent increases through our market over the next few years. The other thing to understand about the market is its size. This is not by European standards a huge market, but by Irish standards, we have a market which is at least 13 billion euros, which incidentally is about the same size as the Dublin CBD office market, which attracts lots of international attention. Because pre-GFC, there were very few international investors in this market, and because post-2015, many of the larger Irish institutions refocused their money on the central Dublin market, which had become very hot. We have limited competition. It's grown in the last 4 or 5 years, but it's still a big market with limited competition, which means we can buy, as I said, between 6 and 9% unlevered, which is between 50 and 200% of what we could get in the central Dublin market. And we're buying assets which are institutional quality with fantastic tenants. It's a great business. We're internally managed. The 3 executives talking to you are employees of the company. We've been exercising this strategy both as a private fund and since 2018 as a public company. We've been doing that for more than 6 years. The 3 of us are employees of the company, and we believe we're fully aligned with our shareholders. The management team has personally invested more than 4.5 million euros in the company. So we're interested in success. We also are interested to avoid failure. So in summary, how did we do? 2020 has been an absolutely horrible year for a variety of reasons, but it's been a very difficult year in which to run a business. However, when we look at our performance, our rent collection has been market leading. We collected 100% of rents in the first quarter, 97% in the second quarter, 98% in the third quarter, and 100% quarter 4. What's more, in quarter 4, we started collecting rent that was deferred in quarter 2 and quarter 3. So improving those 97 and 98% numbers. That puts us near to the top of 80 listed European property companies, top 2, top 3. Our portfolio has performed well at the same time. We have a 141 million portfolio, and that portfolio has a small exposure to retail and we are predominantly exposed principally to regional offices. And if you look at the regional office market, you would expect that to fall in value. However, between December 2019 and June 2020, our portfolio fell by 15,000 in value. Fantastic performance. And finally, as you've already heard, the outlook is very positive. Clearly, during 2020, with people working from home, with continuous lockdowns, it's difficult for investors or tenants to make moves to new offices. However, as we approach the end of the year, as the news on vaccines has got better, so we have seen pent-up demand being released. And Michael is going to talk a little bit about asset management, but over the next 3 to 6 months, we expect a flood of asset management, which will help drive our rental upwards. We agreed with our shareholders about a month and a half ago that we should increase the leverage in the company, and Charles is going to talk a little bit about leverage in a minute, and that will allow us to use some of that increased leverage to buy more properties and improve returns to the shareholders. We pay a quarterly dividend. It's been a progressive dividend throughout this year, and our outlook remains positive. So thank you very much for that. I'm going to hand over to Charles, and he will tell you about our financial position. Thank you, Charles.
Thank you, Jonathan. So in 2020, I'll start off by taking you through the historical highlights of 2020. First of which, as Jonathan's mentioned, we've had strong collections, rent collections throughout the period, both second, third and fourth quarter, increasing throughout the year, ending up in the last quarter at 100% and collecting some of the deferrals from before. So our rent collection has been strong. At the same time, the quantum of rent from our rent roll has been increased. Our contracted rent at the beginning of this year was just under 9 million euros, over the first half to 10.4, up to 11.1 million euros in July. And while that increased at the same time, we maintained the tenor of our portfolio as well, with the tenor of 4.6 years to break being maintained from the first and again of the year through to the year point. At the same time, that rent roll we have is reversion, and we have looked to capture that reversion and additional income from those same creditworthy tenants throughout the period. So while lockdown may have slowed tenant activity, we have still, through asset management, been able to increase that rent roll from those tenants. From a valuation perspective, the portfolio was valued at 141 million at the half-year point by an independent third-party valuer. The difference in valuation from the beginning of the year was 15,000 euros. So we've shown not only strong income, but at the same time, strong maintenance of value in a pandemic. At the same time, looking forward, we have a strong acquisition pipeline. And at the same time, we are putting in place the capital in order to continue to purchase assets within that pipeline. First of which is the 100 million share issuance program approved by shareholders in the middle of this year. And the second of which is our target loan to value being increased from 20 to 40% by shareholders at an EGM in the third quarter. The next page looks at the growth of our assets. In the first half of the year, the property portfolio grew by 22%, rent roll by 17%. And you can see the growth of the portfolio and the rent roll in the chart to the upper right. After the half year end, there was a further letting which increased the rent roll by another 7%. The portfolio at the moment is under rented and has vacancy. Those together, first of which the under rental, there's an additional potential 600,000 euros per annum to be captured. And vacancy, if filled, would add a further 900,000 euros to the rent roll, and we are working on both of those. The company, in capturing that ERV, has regularly outperformed the valuer's expectations of ERV, and we use the valuer's slightly more conservative expectations for this presentation. So while our rent roll has increased, we continue to be firm on costs, and that's shown in the bottom right-hand chart. As Jonathan mentioned beforehand, we have invested our own money in this company, and we have been running similar assets for over 6 years. We are keen to keep our costs down in order that as we grow, we can show the operational leverage, whereby the further assets we take on do not come with an incremental cost to the company as well. So the benefits of that extra rental, a higher proportion of that, flow through to shareholders as dividends. The next page looks at dividends. So the company distributes quarterly dividends, and those are the majority of its EPRA earnings per share. And you can see those in the green bars on the top right chart. You'll note in June 2019, an additional capping blue bar, that was a lease surrender we negotiated on an asset that we purchased, which produced additional revenue for that period. However, for this year, even in the pandemic, we have paid quarterly dividends, 1.2 cents for the first quarter, 1.25 and 1.3 for the third quarter. And there's further reversion to be captured for quarter 4. I mentioned leverage and the increase in leverage before. The chart on the bottom right-hand side shows where Yew Grove sat versus a number of other property companies and REITs. And we show Yew Grove in the green cross in the bottom right-hand corner. What we do here is we show loan to value against dividend yield. And we see from that Yew Grove was among the higher of the dividend yields, but relatively low on a loan to value perspective. Having seen the security of the rent collections from the tenants we have, being government and FDI, and having seen also the security of the value of our assets, our shareholders in the third quarter agreed to increase the target LTV to 40%, which would bring us, as shown in the graph on the bottom right, up to around where the majority of the other comparable property companies are. But still, we would expect our dividend yield to improve slightly with that extra year, that extra benefit of the rent roll coming through as well. I'll take you briefly through some key facts on our balance sheet. What this really shows is this shows the growth there was over the first 6 months of the year in the portfolio. Key for times like this, however, is I have mentioned leverage, but now is liquidity. So you see at the half year point, 9.5 million euros of cash. Our debt at that point was just under 40 million euros. That was not a full drawing on our facility. We have a revolving credit facility, and we had at that point an additional 8.8 million euros, which we could have further drawn. So our liquidity throughout this pandemic and today remains strong. The following page looks at our income statement. We do a comparison here between the first 6 months of last year and the first 6 months of this year. The key changes here are, first of which, the increase in rental income, 3.69 million euros to 5.46 million euros. That shows the increase in the value of assets that we have taken on. However, if I then go down to the longer box in administration and AIFM costs, you'll note there that costs excluding financing in the periods fell. We keep a tight grip on those costs, and as our portfolio grows, those costs do not rise in lockstep with that, and we are very focused on that too. So through this, we see a period of increasing income and keeping a tight grip on costs for that. The following page looks forward. In looking forward, we look, and what I do at the moment is I'm not looking at the pipeline, but I'm looking at the assets that we currently own. What further things can we do with those assets? First of which, we've bought these assets at the right levels, and we've done what we said we would. If we look in the bottom right, Jonathan has mentioned on a different graph, but to mention again as it's a key point. Since the IPO in June 2018, we have continued to work on the same strategy, and in doing so, we have continued to buy reversionary assets, meaning that at a time when we have been unable to purchase many further assets, just recently, we have still been able to gain further income from the assets that we own, and the same would be true from our pipeline as well. So we have that benefit of a reversionary portfolio. At the same time, what we've done is we've worked to ensure the portfolio leases have longevity to them. And that's shown in the chart at the top right, where both the lease to break and the lease to end have remained relatively constant, again, since IPO. We would look for that to continue at the same time too. So we have reversion to work on, we have an element of vacancy to work on at the same time too, and we work on those at the moment to increase that income. Last of which, I think a key point is our portfolio has been bought well. And one of the areas we look to buy well is we look at the replacement cost of an asset to ensure that when we purchase an asset, we are not at risk of other new buildings being built alongside it. And our portfolio in the aggregate is valued at below replacement cost. And as such, we look to mitigate that risk as things go on. Should it move to the point at which development might be feasible near us, we would have the benefit of valuation gains on our in-place portfolio. But for more details about the portfolio, I'll hand over to Michael.
Thank you, Charles. If we move on to slide 16, we have an overview of the portfolio. The portfolio valuation as at the 30th of June this year stands at 141.1 million euros. We have 27 buildings with 848,000 square feet, approximately 1/3 in industrial space and 2/3 as office space. Our vacancy rate post our Aldi leasing at Millennium Park in July has reduced our vacancy from 11 to 7%. And our rent roll has increased over the period to 11.1 million from 10.4 million. Moving on to slide 17, this slide reflects the quality of our tenants. We have 44 tenants split roughly 50-50 between Dublin and the regions, with almost 80% of our rent roll rated Baa1 or higher. Indeed, 75% of our non-government rent roll are to publicly quoted companies. This quality is reflected in our Q4 100% rent collection previously mentioned, which is an achievement we are very proud of. The current portfolio yield is 7.9%, and our asset management will endeavour to capture a reversionary yield of 8.9%. Our tenant profile currently has the government at 25%, FDIs and large corporates at 70%, with SMEs at 4.5%, which we expect to eliminate when we complete the disposal of our non-core properties. The main sectors of the economy our tenants are engaged in are, apart from the government, life sciences at 36.5% and finance and business services at 18.3%. And with our Aldi lease, we've added grocery at 7.4%. Our approach to our portfolio and asset management is in slide 18. As Charles mentioned, we always try to buy well as possible and concentrate on the tenant credit quality and the resilience of those sectors of the economy those tenants are exposed to ensure that our properties are always of sufficient quality for FDI and government tenants, and our locations have always got good demand and supply dynamics. We engage with our clients to understand their long-term requirements and assist with their expansion plans and the property requirements. We always manage our pipeline to deploy our capital as efficiently and as quickly as possible to reduce any drag on our returns. We move on to slide 19, for example. We have 2 projects running on our life science campus in Athlone. Both tenants want to expand their space by 40% to facilitate their expansion of their operations and their move from 24/5 production to 24/7 production. Project A is related to Building B, and that is a 30,000 square foot office extension with associated car parking. Project B is an office and a warehouse and car park extension project. These projects provide the company with a much higher return than vanilla investment, and the lack of available alternatives mean we can capture a premium to the secondary market. Moving on to slide 20. Millennium Park is the investment we completed in Q1. We tracked this opportunity for approximately 12 months. And when we acquired it, we acquired 140,000 square feet of high quality office space, of which 40,000 was vacant. In July, 4 months post our acquisition, we leased the vacant space to Aldi for a 15-year lease above the expected rental level. This building had been vacant for over 2 years, and our leasing strategy paid off very quickly. The initial yield of this investment was 6.53%, and now that we've fully let the 140,000 square feet, the yield to the company of this investment is at 9.28%. That will feed through eventually at year end through to our valuations, and we would expect a capital value increase as a result of that letting. Moving on to the next slide, which is the pipeline and outlook. The pipeline in front of us currently is very attractive. It's currently 147.3 million euros. The yields are attractive at 7.78%. And as previously mentioned, there's significant reversionary yield to be captured by asset management at 8.87%. This pipeline is spread over 9 properties, of which the office makeup is 70%, and the industrial makeup is about 23%. The location of the assets is approximately 70% in the Dublin Core Plus area, with a balance in the regions and suburbs. And the tenant mix remains pretty close to our existing portfolio, with government tenants at 34% and FDIs and large corporates 63%. So with that, I'll hand back to Jonathan.
Thanks, Michael. Okay, the summary and outlook is pretty simple. Our focus on credit quality has really helped us outperform this year. We have a reversionary portfolio, and our view of our markets is positive, notwithstanding questions about the future of the office. For us, the future of the office in our market is bright. And today's market offers real opportunity to a manager like us, and we think continued growth will help the company benefit from the operating leverage, which Charles talked about, and boost our shareholder returns. And while that's happening, we'll continue paying quarterly dividends to our shareholders and underpin those with a stable value. So I hope that gave you a good introduction to the company, and I look forward to your questions. Thanks.
Thank you very much, Jonathan. Thank you, Charles and Michael. I have had a number of people typing in questions, but I think we will have time for a few more. So I do encourage you, if you have got any questions, please do use the Q&A button at the bottom of your screen, type them in, and we will endeavour to answer them. But just to run through some of the ones that I've been jotting down as you've been presenting. Talked about the pipeline. Could you give us a little bit more information on where you're targeting? Is there any particular preference for certain geographic areas in Ireland, any particular sectors where you're focusing, or types and age of building?
Well, I'm going to pass this over to Michael to answer. And the answer is clearly yes, but I'll let Michael answer the question.
Thank you.
You're on mute, Michael.
Sorry about that. In terms of our focus, we always try and acquire as much industrial as possible, and we would like a slightly better mix of industrial versus office. A major focus is on the life sciences and the med tech sectors, and the sectors of the economy that have proven resilient over the last year. So to that end, we follow where the FDIs are going, and the FDIs are going to the suburban markets, the core plus markets, and into the regions. The percentage of the core plus in this particular pipeline is quite high because in those cases we're tracking government tenants and chasing government tenants in those particular locations that are very attractive to us.
Thank you, Michael. I've had a question on rent reviews and leases. I wonder if you can comment, the questioner asks, are all rent reviews open market, or do you have index-linked reviews? And can you also comment on the typical lease lengths at present?
Sure, I'm going to pass this to Michael again.
Yeah, so the rent reviews for legacy leases are upward only and are open market. The latest generation of leases, the rent reviews are both upward and downward. In terms of the lease lengths, we were pushing out to averages of 17 with breaks at 7-8. And I think within the COVID period, people have been happier to go a little bit softer with 10-year leases of breaks 5, just to get transactions over the line. In terms of the upward downward reviews, that is pushing a lot of people to agree CPI indexed review step ups rather than open market reviews.
Yeah, and we have some exposure to CPI already in our Athlone campus, and we expect that to grow as a part of our portfolio, but not necessarily the majority.
Okay, thank you. The next question is more of a strategic one. Do you have a target size in the medium term for the size of the REIT, particularly to make it larger and more attractive for institutional investors?
We definitely do, Tim. I think let's separate the question about the portfolio from market capitalization. I mean, I think we'd like to grow the capitalization of the company regardless. More liquidity is a good thing for our shareholders. However, when we look at the portfolio, we believe that within the next 24 to 30 months, we can grow this portfolio from its current size of 140 million to somewhere between 750 million plus. Now, clearly that depends on us getting support from our shareholders, but clearly we believe the opportunity is there, and we think that growth in size of the portfolio, together with the market capital that would represent, would make the liquidity far more attractive and make the company far more attractive.
Okay, thank you. Moving on, the next question is regard to Brexit. Do you see Brexit having a positive, negative, or neutral effect on asset values and occupation levels?
Well, I think, and perhaps more than one of us can answer here. I think our view of Brexit is that Brexit has been coming for a long time. And so it's clearly Ireland and the UK are connected at the hip, especially in the agricultural industry and in cross-border transactions. And, you know, let's ignore the politics of the border. However, for the businesses that we're involved in, for those multinationals that situated themselves in Ireland, they're in Ireland for a reason. And if anything, Brexit makes that reason even more compelling than it was previously. Most of them have had long enough to sort out their exports. If they used to be via the land bridge, they've looked at alternatives just in case the land bridge fails. And in our view, if anything, this makes Ireland more attractive to our tenants than it was before. That is not to say that the Brexit will be easy for Ireland. We just believe for the business that we're in, it's a positive statement. Michael, I don't know if you want to add anything to that.
Yeah, I mean, we separate the domestic economy from the FDI economy in that regard, and the impact, I think, that would be well flagged would be in that domestic economy. In terms of the FDIs, and I've talked to pretty much all of them, they had sorted out their supply lines and their export routes. Back at the the previous cliff edge, and they've now refined that, so they are all pretty geared up and very confident. And again, we're talking about companies like 3M and Teleflex and Optum and PPD. I mean, these are world-class life science operators that operate both in the UK, in Europe, and the US globally, and they have the wherewithal and the resources to prove themselves against a lot of these issues. So we're confident about our current tenants and portfolios, and even with that pipeline, again, it's in similar types of sectors that we're pretty confident that these are expanding businesses and will be in their locations and in country for a very long time.
Thank you, Michael. This area is probably more one for Charles. We've had a number of questions around the concept of the increased leverage and debt. Questioners are asking about the availability of finance, the sort of rates that you're having to pay, and also sort of more strategically on the thinking about increasing the leverage at the moment, and whether this is something that's appropriate.
It's absolutely right. This is one for Charles.
So our existing facility is a revolving credit facility, which works well for a growing company. We pay 2.4% drawn, 1.2% undrawn on that. And that's not fully used at the moment because we're maintaining ourselves within our old target, so to speak, of in about the 25%. As we look to grow, we note a couple of things there, one of which is, while we have not completed the negotiations, my expectation is that what we will negotiate would be both a longer facility and at the same time one which has a cost which is no greater than our prior facility. Our prior facility had a maturity of December 2021 with an extension of a year. I would expect a facility we agree to be longer and cheaper than that as well. On the availability side of things, this has been made available to us, and we have negotiated with a number of counterparties there. And the mix of counterparties has been predominantly local counterparties, some of whom are interested in the entire facility for themselves, others of whom, as we grow and become more established, and because they have followed our portfolio and the stability of that portfolio, have become more comfortable in lending towards us and would be interested in a part of a facility going forward. However, to be absolutely clear, that has not been inked yet. So we have the ability to go out and to increase our facility along the lines of what allows us to do what we would in the future. I would imagine, again, it would be a revolver that works well for a growing company and allows us to use that cash when we become more comfortable around liquidity to pay that down to decrease the costs that might come from it.
And one of the questions I think was, do we think it's strategically appropriate? Clearly we do. We don't believe that leverage for its own sake is a good thing. But given the quality of the portfolio and given the quality of the pipeline in front of us, it is important that we execute on some of that pipeline. And it's unlikely that in the next couple of months we'll be raising equity. We have to get through the year end, we have to produce our accounts. And so the increased leverage will help us execute some of that pipeline and pass the rewards on to our shareholders in increased returns.
Okay, thank you. And a related point, do you see that there is a sort of short to medium term opportunity there's obviously a lot of assets are still being traded at small margins over build cost, or even at build cost or below. That's obviously not sustainable forever in a growing economy. So is there a short to medium term opportunity for you to grow the portfolio that you wish to capture?
I think medium term, I mean, again, I'm going to open this up to Michael in a second, but in our view, it's a big enough market, and notwithstanding there have been growing levels of investment, and we've seen more competition. For example, the industrial market is very competitive, but even though competition has grown, the market is big enough and deep enough that a well-situated investor can pick up assets cheaply. That will continue for at least another couple of years. And therefore, part of the growth for us is buying the right assets in size over the next couple of years and really getting some scale. Michael, I don't know if you agree.
Yeah, I mean, the year in, year out, we just keep seeing this, the pipeline continuing. So I'm very confident, over the short term. We have visibility into 21 in terms of where the assets are coming from, our origination process. It's the end of the tax CGT holiday. A lot of assets will come forward from those assets that were bought 7 years ago and had to hold till then. So yeah, I mean, I'm pretty confident that there is enough to go around, and a huge amount of opportunities for us, and we remain very confident. Just going on to the pipeline, that pipeline is our top 9 picks. That's not the total pipeline. There's the same again behind that we're crunching through and dealing with the counterparties. So very confident about the pipeline.
Okay, thank you. One maybe for you, Michael. One of our questioners asks about if you could give a bit more information on the life science sector clients. The perception certainly over here in the UK is that a lot of life sciences companies are loss-making. Maybe their financial status is not top quality. My understanding is the Yew Grove tenants are very different from that, but I don't know if you want to comment and give us a bit more of a flavour of what sort of companies they are.
It might be down to definition, but just looking at slide 17, Optum is the technology side of United Health Services, and does everything from health insurance through to developing doctor client appointments over the internet. KSCI is one of the med tech parts of 3M. 3M is I think one of the most successful companies at the moment going through the whole COVID scenario. Teleflex again has got a huge stable of drugs, medical, med tech, etc. So these are all large multinational, as opposed to PPD is a drug trial at every level, drug trial and vaccine trial, a corporation. So they're big. They're not in the experimental stage. They're at the mature stage, where they're part of large conglomerates.
And I think the reason for that is if you think about life sciences, the Irish universities, like the UK universities, have spin-outs of startups. But those spin-outs are not really looking for large offices or large industrial buildings. They're being looked after in the equivalent of some sort of startup building. Our tenants are tenants who are already successful, who are situating themselves in Ireland as a beachhead into Europe, or an export, the European head of an export market back into the US, or services market back to the US. So by definition, they're already successful companies. And so the life sciences sector is one of the most successful sectors for Ireland of all of its FDI investments. However, those companies are, by and large, extremely profitable, pay a lot of tax in Ireland, and are a great set of tenants for us.
Yeah, thank you. I've had a couple of questions on ESG. Obviously, this is an important area for many investors, particularly institutional investors these days. Could you give a little bit more colour and comment on ESG policies and what you're looking at with both the existing portfolio and new investments?
Yeah, look, ESG is very important for us. I mean, clearly, because we're not building, by and large, we don't have brand new buildings. Most of our buildings were built to the standards of their day, whether that was 2005, 2008, wherever it happened to be. So we have a series of projects going through our existing portfolio to upgrade the buildings, to introduce building management systems, to make them greener, to use more renewables, have better lighting, better ventilation, although many of them are actually naturally ventilated, which is a good thing in today's market. But so we have a series of ESG projects going through to improve the quality of the buildings. And as we look to new developments, clearly we're interested in the NZEB, the near zero energy building. Now there's only one such building in Ireland to date, which IPUT have just built in Dublin. However, we expect to publish in our year-end accounts the progress we've made to date, and you should expect to see Yew Grove slowly but surely improving the quality of its assets, improving the quality of the locations and the communities in which we're situated. And from an ESG perspective, I would hope we're all treated fairly inside the company, but we take an active part in the social networks we're involved in, and we are very conscious of our building's contribution to greenhouse gases, and we're going to help reduce them.
Thank you. Moving on to another area, one person who's new to the company has asked if you could give a flavour of the current shareholder base and who some of the larger holders are and how it's spread.
Well, I'll try and do this, but Charles will correct any failures. We have a rump of shareholders who rolled over from our original property fund. They account for approximately, I think, 15% of our shareholder base, mainly city professionals. We have a number, and clearly the management of the company own approximately 4.5%, give or take, of the company. Then we have a number of very large institutions, people like Royal London, Insurance, Invesco through the fixed income arm rather than the equity arm, AIB, Fidelity, a series of large investors. We are very keen to do a couple of things. We're very keen to expand the shareholder register, get different names on the register. We're very keen to actually expand the number of wealth managers on the register, specifically the mid-sized wealth managers. And we're very keen to increase the number of retail investors. And the reason for changing the register, shareholder register, is it's better to have more shareholders, but having more retail and small wealth managers increases liquidity. Now, we would like to see the shares move because of our performance, not move because they're illiquid. And so that is one of our key focuses for 2021. Charles, I don't know if you want to add anything to that.
No, I think that you're absolutely correct in that. The shareholder register has seen relatively little movement over the 2 and a bit years since the IPO itself. In that period of the institutional side of things, a number of those who joined at IPO have increased their positions when we've had offerings since then. A number of new investors have come on and very few investors have left. I can think of only one example at the moment of an investor who has sold out of the entirety of their position. And the reason for that was a restructuring of the fund in which that position was held. So it's been pretty secure and pretty static over the 2 and a bit years in existence.
Okay, thank you. You obviously did give some mention to COVID and future office use, but just be interested, I've got one question here. Obviously the pandemic's had a massive impact on all our lives. How do you personally see that impacting the office market going forward? Is there going to be a need for less offices, more offices because we need more space, or pretty much the same as it is today?
I think I'm not going to try and answer the question for the global office market, because I think each of the markets have their own drivers. I think in Ireland, you can separate the market into effectively central Dublin and maybe the Core Plus and the rest of the country. The key points about, and you have to remember that Dublin is a much smaller city than London, and people tend to try and read London across into other markets. But the key point about Dublin is that in Dublin, you have had the growth of brand new, grade A, fantastic, quite large new offices, largely taken by tech companies. Now, whether those companies want the space they've taken or use all the space they've taken, they have those leases and they're long leases. What we also have in central Dublin is the government is a very large tenant. Most of its space, not all of it, most of its space is actually not fit for purpose. And the OPW, the Office for Public Works, which operates, negotiates most of the government leases, has publicly stated they would like to reduce their rent costs. And there's only one way for them to do that, because they do not want to work from home. The way for them to do that is to move out of the centre. What we see happening into the suburban offices in Dublin is that some of the larger companies will move to some form of hub and spoke to reduce their costs. So central Dublin will become the shiny headquarters office, and they will have convenient offices for their staff to travel to, commute to, situated around Dublin in the better situated business parks. We think that the rest of country is a totally different ballgame. You don't have large conurbations. You don't have people commuting by public transport. People generally drive to work. Not all, but generally drive to work. And in those places, clearly people are concerned about the health of their staff. But in general, while working from home was pleasant the first time around with sunny weather, and it was a new experience, as a permanent fixture, it really works for experienced members of staff with large houses and big gardens who've already developed their relationships. For the vast majority of office employees, it's not really a great thing to do. You need to be in the office, even if only for 2 or 3 days a week. The offices will persist, and because of the supply and demand metrics of the regional Irish office market, that market will continue to grow and thrive. Michael, other points I've missed?
No, I think you're spot on. I mean, I think that the office will remain the high impact part of the interaction of employee and their management and what they're doing. And the HQ, as Jonathan said, and the hub and spoke model will play into that. And whether it's the high profile kind of Googles, Facebooks, LinkedIn's, Twitters in Dublin, whatever the corporate wants to do about work from home, I know from experience that all of the staff want to be in the office. So there's that dynamic that a lot of the the millennials want to be in the office and participate in that high impact activity. Going down through the country, as Jonathan said, the nature of again of our tenants, whether it's business services, they have to get back to the office. There will definitely be some work from home component of that, whether it's 1 or 2 days a week. But equally, there will definitely be a requirement for more space per head. Now, our experience, over the last 3 months is, no one looking for less space, and a number of tenants looking for very short-term or short-term swing space, i.e. something to get their people back into spaced office space. So again, this is just specific to us. I can understand, big conurbations, the New York, London, the dynamics are going to be different. But in our space, the office is going to crack on.
Thank you. And do I take from that, going to another question, that central Dublin remains unattractive and not a focus of Yew Grove?
No, I don't think central Dublin is unattractive. It's just not a market. There are plenty of people who are very active in Dublin and do a great job. And we are one of the key movers in our space. And so I see no real value in trying to diversify into somebody else's backyard.
Makes sense. Thank you. I think that that covers all of the questions that we can answer on this session. However, if any attendees do have anything further, please do not hesitate to reach out to me, Tim Metcalf at IFC Advisory, Yew Grove REIT, investor-focus.co.uk. You'll find my contact details on all of the company's announcements and on the website. And if you email through, we will endeavour to answer those questions we couldn't answer tonight, or any other ones that you have. But I'd like to thank again Jonathan, Charles, and Michael for the presentation. But most of all, everybody who joined tonight, and I hope you found the session useful. Thank you, everybody.
Thank you, everybody. Good night.
Thank you.
Thank you.